the socials. Let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Good morning. I can't wait to do this. I feel just plentiful of riches being in your presence today, especially someone who has now got who's worth so much more now that he has a real house coming shortly. He's growing up. He's pulling his big boy pants on. Now, as
less
they said,
Doug. I'm worth less now.
He's worth less. That's right. No,
Not worthless. Worth less.
Worth less. Hey, there's probably. Hopefully, there's a little equity in this new place you've built. And it's so usable as everybody thinks. I just go get my equity. But I've got I'm bountiful of riches, unless I'm sitting in cash, Kirk.
Yeah. Well, Doug was jumping the shark because I haven't actually signed the P&S yet. That's later today, but we are going to move forward with our new home purchase. So all of you audio viewers will appreciate the fact I've been a renter for 5 years and been a proud renter because I saved a ton of money from owning a home. But I also want to point this out that if any of you are looking to buy a home, don't, because I am really good at picking the top of the market when I buy a house, and I'm pretty confident that I'm picking the top of the market here. I've started to see signs in the area in Massachusetts, things coming off, these overextended prices. So you might want to wait a little while, wait till the dust settles, wait a few years before you buy, and I think you'll be happy because I'm clearing the way for you. I'm calling the top right here.
Hey, Kirk.
Yeah.
Kirk, I bought my house in Colorado in late 2006. How's that? How's that for timing?
I bought my condo in the city 2006. I know it. Like I could feel it, but back then I bought it for a huge discount, so I was okay. This one is not a huge discount. No. This is like, all right, I'm going to be living out of my car so I can afford my house payments.
No,
anyway.
I built mine and it did not get, and I had to put $100,000 close to $50,000 in to landscape it, because that was, the requirement of the new build is you get that burden.
Yeah.
That house did not get above what I bought it for and the amount that I had to put into it till 2014.
Yeah.
So looks good now, though.
I was talking to a friend of mine like way back when I started, and he bought a house out in Hopkinton, like central kind of western part of the greater Boston area. And anyway, so I was talking to him, and he bought in this new development neighborhood, and he's smart. So he's like, all right, I'm going to put in some landscaping, put in the sod, do it right, spend the money. And he's like, I'm the only one in the neighborhood. Everyone else has got this rocky dirt with some seeds on it, and it looks like crap. He's like, my house looks great. And I put in the money up front, and he's like, I don't have to do much maintenance after that. Just water it. Everyone else, it just looks like crap for years. And I always remember that lesson. And from the buyers, they seem like nice people, but they really value the interior of the house, and they didn't value the exterior so much. And that's obvious. And so we were looking at two houses. One house, the interior was great. The exterior, mediocre. Let's just put it that way. It's got some hair on it, not actual hair, but it's got some issues, which we take on. The other house had a legendary exterior. It was backed up against conservation land, like mass wildlife conservation. Like it was like 1,000 acres, like lakes. It was beautiful, and the house backed up to that. But the interior of the house had a lot to be desired. So we chose, similar to obviously the sellers, great interior, exterior needed work. And I figured, I'll just put it in, it's fine. But the views in the other place were like, oh my God, I want this place. It is so beautiful. But the house, I was like, I just couldn't do it. And that's how good the exterior was. And I don't, as my wife told me, he's like, you don't live outside. not today anyway. So Doug, I can't hear you.
I have to acquire. I think there's a wait, there's more. I thought you got the place next to the conservancy.
No. It needed like $100,000 to $200,000 worth of work, and so we had to discount the price a lot. It wasn't perfect. It was fine, but it was from the 80s, and as the broker said, you have to see this with the context of it's a point in time. And I was like, oh, great, thanks. A point in time in the 80s, and nothing's happened since. So, it needed some work. It needed a lot of work. New windows, new appliances, new everything. So, but it wasn't a bad place, just not for us. So, anyway, we're signing that later today in the PNS, so we'll be closing the end of the month. So I'm happy about that. So I'll finally have a backdrop that I don't have to have this artificial backdrop. So it'll be nice. We'll see. We'll see how that looks on the camera. But anyway, enough chin wagging. I'm sure everyone doesn't really care about that. Lots to talk about. So let's start with. Let's just dive right in. We got tons of topics. I'm going to move past the the lesson today, and I'm just going to go into like what we're seeing, because what we're seeing is really interesting. So I don't know if anyone paid attention, but I have, and there is a bull market going on, and it's not in stocks, it's not in international. Well, I shouldn't say it's not in U.S. stocks, it's not in international stocks, it's not in bonds. Where do you think it is, Doug?
Let me think here. Not sure. Could it be gold?
It's gold, Doug. It's gold. There's gold in them hills. Them are hills. Yep, there's gold up there. So I'm just showing. This is the snapshot for today for the S&P 500. And those of you audio viewers, sorry, you can go to YouTube and see this. But it basically shows that the markets are not all that great today. Now today's just one day, but let's be honest. This is the week. It looks the same. September is traditionally one of, if not the weakest months of the year. Now, it's not all of September. It's traditionally right around the 15th, 17th. When's the next Fed meeting, Doug?
It's coming up.
17th. I am pretty sure it's the 17th.
I think so.
It is. Point being here is not that you should go jump out your first floor window. The point is that September is a weak month. The first year of a presidency is typically strong. September is typically a weak month, followed by October, November, and then right around mid-November tends to be the Santa Claus rally, which goes into sometimes the end of January, even mid-February, depending on the year. So, we're heading into a soft period. So those of you who are worried, and I'm saying this because I read this everywhere. Everything is talking about, oh, September's gonna be a bad month. Everyone's out. Everyone's hedging. They're taking profits off the table. Well, what do you think causes September to be a bad month? Everyone's selling. I don't see a reason to sell, which is interesting because most people are talking about selling. Now, what would be the least probable outcome for everyone thinking that the market's going to go down? The market's going to go up. The market typically does the least probable thing. And so if you think that the market's going to go up or down and you don't know which one, it's probably going to be neutral. If you think it's going to go down, it's probably going to go up. It's the way things work on Wall Street. Whatever your emotional fear signal's pointing, go the other way. Or greed signal. Whatever is pointing, do the opposite. You're probably going to have the better luck. That's typically how it works on Wall Street, just from my experience. Now, the whatever's happened up till now this year, I think the S&P is up around 10% or so. But if you look at commodities, now oil's not done all that great. It's it's kind of bounced around. It's not really done much. You'd think it would have done better, but it hasn't. Natural gas, same thing. Bonds are so we'll get to bonds in a minute. Let's get to metals. All right, precious metals. Let's look at gold. Wow, that's a nice chart. Look at that thing. Goes from lower left to the upper right. That's exactly what you're looking for. If you're looking at about it's more than a year. I don't even know how they do this. Year and a half. I don't know. Year and a half, somewhere thereabouts. This chart for gold is about a year and a half, and it started right around 2000. Right now, it's about 3650. Is right around where it is today. Now, you'll notice here there are times where it goes sideways for a bunch of months, and there are times where it goes up, right? And sideways, we just started to go up again. And those of you who are clients, you know what we're doing. But like, if you look at this in the last week, It is just broken out at all-time highs at the moment. More importantly, let's look at silver. Wow, look at that. Now, I point out silver. Let me point out a framework first. Okay. Here's what's been happening. Now, gold has been doing very well. This is silver for the last 30 years. Here's gold, the last 30 years. You notice there's a very big difference. Gold has done a lot better, especially in the last 12 months, 18 months. But if you look at silver, a little different. So I want you to keep something in mind. The context of how precious metals work. And I'm saying this, and I guess this is the lesson today. I'm saying this because of this. Most people don't understand gold. They don't understand silver. They don't understand the metal sector at all. What they understand is you're a gold bug and gold's great and everything's gold, or I'm not going to touch that. It's a barbarous relic, or whatever your mindset is. If you have some philosophical viewpoint, you're wrong. Here's how to think about it. Gold tends to trend. If you look at this chart, in the 90s, it went down. It hit a low right around 2001. And that was the low point. I think it was like $275, somewhere thereabouts. I forget what the actual low, 265, 250, maybe it was 250 was the low. And then it went on a rip-roaring bull market from $250 up to peak of $1,800. This shows a little higher, but I thought it was $1,800 was the peak. So that was the peak of the gold market. And then it went down and took a rest for a good 10 years. And now it's starting to go up again, and it's going up hard. Now, why? Well, let's talk around the issue. So gold is starting to take off. Why is it taking off? Well, there's a lot of reasons, but have you heard any of your friends or your family or your financial advisor, if you're using one, talking about gold? Probably not. Here's why, is we're at the early stages of a bull market. Now, what tends to happen is gold tends to move first. So if you're looking for a bull market, it tends to be gold moves first, then silver, then mining stocks, and then junior mining stocks. Junior miners being the most aggressive, risky assets. They're basically like they're like a lit match. Like there's nothing valuable about a junior miner. It's just a lit match. You just have to time it at the right time to get into it and take advantage. I hate them, but sometimes you can take advantage.
They're the penny stocks of commodity.
Yeah, basically, it's the shit coin of crypto. It's basically what it is. So if you look at, and the reason I'm pointing this out, this is a huge lesson, because if you notice gold, it's been taken off for like the last year, and I've been in gold on and off for years, and I always have a position in gold. In this low period, it was a very small position because it wasn't doing anything. But once it starts to rock and roll, that's when you start to add exposure. Now, gold is first. Now, what is driving the gold price? Well, I'll tell you, most people think it's inflation. It's not inflation. Now, here's the thing. If you thought it was inflation, why didn't it skyrocket from 2020 till pretty much 2023? It actually didn't do very much. It was up maybe 10%, maybe less during that period. It wasn't very much. It should have, but it didn't. Because gold is not necessarily tied to inflation. It is over a long arc of history, but not over a short period. So if you're looking at a year or a few years, it's not going to correlate very well. It's like saying that the dollar's up and gold's down. No, actually, the correlations are not very good for that. So you'll hear that. Everybody will say it because they're convinced it's true, because logically it should be true, but it's not. Just look at the data. It's not how it works. So think about gold. Gold's starting to take off. Well, let's look at silver. What has silver done over that same period? Okay, well, silver's kind of started to take off, but not really. It's come up a little bit. The all-time high in silver was $50. And that was in 2011. The all-time high of gold was, let's see, we hit just under 2,000. We had 1,800 at the same period, 2011. Since 1,800, it's at 3,600. It's doubled in that subsequent 14-year period. Silver still has not exceeded its all-time high. Interesting. So,
which is
let's look at this.
actually really bad when you compare that price to inflation.
Yeah. So a lot of people love silver. They're like, oh, silver, and they come up with all these theories. And believe me, I know them because I've studied them all. They talk about, well, silver's, it's not around, it's used industrially, and it's better use, and it's, it's a bad ratio. It's 80. I think right now it's 85-1. Historically, in the Earth, it's like 16-1. They'll go through all these theories, and they're not wrong. I want to be clear. I love gold. They're not wrong, but the price will tell you you're wrong. Because if the price says, hey, we haven't hit all-time highs in silver yet, that means you're wrong. It doesn't mean that you're philosophically or, even informationally wrong. But when the price says different, it means you're wrong. And so you have to own up to that. And that's hard from an ego perspective. So the reason I'm pointing this out is compare this. Gold has doubled the all-time highs. The all-time highs for silver is 50. Right now, we're at 41.50 for silver. Where do you think silver has to go to even equal what it was at the all-time highs of gold? It's got to go a lot higher. It's more than double where it is now. So if you look at that, you say silver can very easily take off. Now, if you look at gold, gold's like the large cap stocks, the safe large cap. Silver's like the small cap stocks. Like there's a lot more adrenaline junkies in there. It can move really quickly. So silver tends to move next. So gold goes first. And by the way, the reason gold is moving is because central banks are buying it. It's not because Doug and I are buying it, because we may be the only ones. No one else is buying it. Like, I'm not hearing advisors, I'm not hearing portfolio managers talk up gold. It's not happening. But central banks are buying it every single month, day in, day out, because they know what's going on. They don't trust the system. They made the system. They don't trust the system. They're buying gold as an asset to secure, their assets, their balance sheet. So they're buying. Now, this sign right here shows me that investors starting to notice, because central banks don't buy silver. They need to buy too much of it, and they would move the market. There's no way they're going to buy silver. They buy gold. So who's buying silver? Individual investors. It's too small for most people. So individual investors are driving the silver market. So you want to know when silver is going to take off? It's when everyone else understands that precious metals space is the place to be. Now you're starting to see silver starting to take off here. You definitely noticed it. It broke out of 40 this week. Big, maybe it was last week, but big news. Broke 40. It's on its way to 50. That might be a little bit of a headwinds, but getting there, I think it's going to go quickly. I don't know where it's going to go. I'm speculating. I'm just telling you my opinion from 25 years of doing this stuff. But I don't know the future. It could just go down. But my point is when this stuff starts to shoot, it really starts to go. So silver's next. I'm not going to get into platinum because it's kind of unrelated, but we did see a sharp spike this year due to other things. Copper is somewhat related. It's not really tied to this. It's more due to industrial. But silver and gold are the important ones. Here's what comes next after silver and gold start to take off. What comes next are the miners. Now, I don't know if you notice, if you're looking at your screen, this is the past month and a half. Really this year, actually. This year, miners have, I believe this year they've doubled. I think they've doubled in the last 12 months, I believe. I'm trying to pull up the chart, but I believe they've doubled. Yeah, you're down to 35.
Yeah. It looks like December they were about half of what they're worth right now. Yep.
Yeah, it's not quite double, but it's pretty close. So miners have started to take off. As you've noticed, they tend to. This is the past year. It's been before that, but definitely in the past year they've really started to take off. So it goes gold, then silver, then miners, because miners are like silver on steroids. Miners are one of the worst business models on the planet. They generally don't make money. They lose money, and they have a depreciating asset. They own land with gold in the ground, and they pull it out, and now the land's worth less. So,
and they have to pay money to get the gold out of the ground, which
and they don't know
the more demand the more demand there is can actually cost them money, and this is where they can actually lose money in a rising commodity market.
Yeah, and here's I'll wrap it up and give it to Doug. But here's the thing about gold: miners is it's a terrible business model. They frequently don't make money, and the large caps are typically the worst. Although there's one that's always been bad and it's actually cleaned up its act. I'm not going to talk about it, but on the show. But those of you who know me know what it is. So the miners get next, and the last one to go is the junior miners. These are the lit match. You're starting to see these things are starting to take off. Now these have doubled in the last year, and they look like they're just starting to run. So take this all back. What you need to know is that this is happening. That's one thing you need to know is this is happening. Don't ignore it. You're not in at the earliest stage, but you're in really early. They have, in my opinion, based on historical metrics and what I study, it has a long way to go. I'm not saying it's going to run like this, like we saw for the next few years, but it should continue to glide upwards over the next few years. And whether it spikes or not, I can't tell the future. But the potential, if I look at all markets around the world, the best potential I see is in that sector. Everything else is overpriced. This is underpriced, and it's becoming more. And the higher gold and silver go, the more the miners are worth, because they're like exponential, X return on the price of that metal. So as it goes higher, they're worth more. So I would just, I'm not going to give you specific examples. I was just showing you generally as a not saying to go buy the miners. I'm just telling you how generally the process works in these cycles. And that cycle's just starting. I'm excited. I'm super excited. I could very well see the prices drop sharply and freak people out. I'm not freaked out. Like you want to be a strong hand in these things because it will make you seasick. It's not as bad as crypto, but it's definitely not for the it's not for the pensioner who's living off their income. It's for people who are willing to take a little bit of risk. But if you can, it's a great opportunity. If you miss crypto, you miss the big trends, you want to watch this if you have the stomach for it. All right, Doug, we got lots to talk about. Where do you want to go? Oh, you're muted.
Yeah, sorry, I'm trying to. Kirk's hearing voices. I don't know if it's the tinfoil hat that he normally wears, but he's hearing voices and he's hearing himself speak in his own head. Which, by the way, the true sign of losing your mind is when you're answering yourself. I just want to point that out there for people.
But I'm a good conversationalist, Doug.
Excellent conversationalist. As we could see by you starting the show, you know how to keep the conversation going.
Yep, I had a lot to say.
Yeah, well, there is a lot to say about this, and the thing about I do want to counter one thing that you said there. Kind of I touched on is that gold miner valuations will go up because of the assets that they hold when gold goes up, except when gold spikes at an aggressive short-term level. Because what happens is when the demand for gold spikes, it forces the gold miners to, of course, to meet that demand. They then have to go through not just the reserves they already have, but they have to go back to the mines, go back to the ground. They have to extract more. So there are periods of time where you will find an inverse or at least relationship between the rising price of gold and what happens with gold miners. I just think it's important for people to understand. You touched on it. A lot of people will only invest in gold miners trying to track against gold, and remembering that the gold itself is the price of that asset. Although I want to come back to that. Whereas the gold miners are a company whose business model is driven based off of the extraction and the sale of that asset. And of course, if that asset's worth more and they hold it, they're going to make more money. But they also, being a business, they've got expenses, they've got accounting, they've got equipment, they've got government regulation, they've got all of these variables, and then they've also got to pay the labor and all the things to go get it. And if the mines themselves are not producing at the level they need, then those miners will go out and look for more deposits of gold, which of course now you've got R&D and speculation prices, the wildcatting that goes into it. So again, if all of a sudden there's this massive demand for more gold, it'll drive the price of gold up and can actually drive the price of miners down. I don't see that being the case in this situation. I'm not here to make a prediction. The gold prices are going up fast, but they're going up fast in a very steady, systematic rise against inflation. And I think the gold miners will more than likely, from past experience, temper how quickly they go to extract, which, by the way, will help you if you're a gold holder, because in that regard, that will mean that the supply and demand equilibrium gets off. The miners will, be delayed on how much gold they can supply. That will make the price of gold potentially increase higher too, because scarcity. So there's a number of things that go into those variables. I'm not saying which one's occurring there, but keep that in mind. The other thing that this is very interesting for me is that the gold has been something that has been coveted much greater by the international community than it has here in the United States for decades. And I don't know from a overall country philosophical level whether or not that totally aligns with the gold standard or not. But Americans have been much more focused on building wealth in alternative ways and storing of wealth in alternative ways. Number one, of course, storing wealth by their own dollar. They've also been driven to storing wealth through the creation of businesses and the stock market, a stock market, which again continues to prove itself to be an extremely viable, sustaining way of building wealth. It's also, again, someplace where Bitcoin is coming to play. But the United States as a whole, as you mentioned, Kirk, advisors aren't really recommending it. People aren't running out and clamoring to get it. You don't see lions out of the gold, the gold pawn shops. I actually, as a member of the Financial Planning Association, have been affiliated in this world for a long time. There was a local gold company that would come to our national or our annual Financial Planning Association meetings talking about, actually buying hard gold as an alternative to the rest of the investments. And that drives, another point here is that part of the problem for most investors is actually getting the real price of gold and actually owning the real gold. A lot of investments out there, as I said, they're actually gold miner investments. They're not necessarily holding bullion. The ones that are holding bullion, there is the potential, I'll say the potential, although I have seen examples of this, where the real price of gold is not necessarily being taken into consideration. How do we price gold? Typically, it's through futures. And you can get gold through like gold ETFs, that actually, if you do your research, there are those that actually hold bullion or are attempting to hold enough bullion to match what they have. But the price of gold that we're being listed in futures isn't necessarily what gold would really be worth if you were bartering that to someone with gold in hand. And that they've actually tested this, that it's one thing to go out and buy gold futures based on where they're pricing. It's another thing to go out there and actually trade gold. And if you go to get gold from someone who's holding gold, the price that you will have to pay for that gold may be very different than what the actual futures are calculating right now, which means there is a potential that actual bullion itself in hand may be worth very different, if not significantly more than what they're currently saying it is out there. But going back to the point I was making about Americans, foreigners have been significantly more interested in buying gold and holding on to gold than Americans have for a long, long time. If you go look at certain countries like India, gold is everywhere. If you look at a lot of Indian citizens, they own a lot of gold. They have been storing their money in gold for a long, long time for many, many reasons. Some of that is cultural, but a lot of that also has to do with trust in the currency, trust in the economy. Again, and so we're catching up on this, Kirk. Americans are behind on this. It actually puts, as much as we're like looking at kind of financially and the U.S. and its position as central power and the position of the dollar as an international currency, already in an area where there's waning influence, and already in an area where we are seeing that our wealth and GDP over time, there's the rest of the world has been getting wealthier. The middle class in the rest of the world has been growing, where the American middle class has been, arguably struggling. The fact that the rest of the world is a higher holder in gold assets and reserves puts them potentially, at least in this cycle where we're at right now, in an even greater level of influence and security than most Americans are. And that what does that say? Does it say that you should just dump everything and go to gold? Heck no. The American stock market has continued to do very, very well. We can say all we want about the numbers and the pricing and the valuations. I actually have something out there, Kirk. I posted. If you want to look at one of the last things that I posted, it says reasons to sell. It's a hilarious chart that was posted out there. There's a million reasons to get out of the markets, and we have been the bearers of what I would like to call realistic news, because there is a very, very much a fact that that losses can compound more than gains. That to be in a situation where you're dealing with 14 years of losses like or where we did between 2020 and 2013, that really does matter. I do something with my clients using an income tool that shows what it would be like to enter into different economic cycles. Like, if you retired right before the Great Recession versus during the Great Recession versus after the Great Recession, very different. And by the way, for those of you listening, it's interesting because you probably know someone who lost money, who lost money or had their wealth value decrease. There's a difference going into, say, 2008 or going into 2020 or 2000. And they probably threw their hands up and said, well, I was going to retire. I can't retire now, right? I lost it. Interestingly enough, in most of those historic models, if you entered retirement during the crises, so your portfolio is already dropped, you were actually in better shape and were able to sustain an income that you needed for retirement better than someone who retired right before it. What does that mean? It means that once the crisis occurred, you were probably more secure for retirement than having to retire before and not having that plan in place, in a position to where you were able to prevent being impacted by the risk, by the way, that's already there. And what you're seeing on this picture is these are all the risks. These are all the times that things have occurred, said now's a reason to sell, the news. And the reality is that the market has been phenomenally resilient, right? We can see some certain scenarios like 2020. Again, we were shut down in the economy. Boom, came right back. But look at, .com in 2000, in 2007, 2008. And again, the markets, for the most part, over time have come back, but timing matters. Sequence of return matters. So I'm not saying get out of the markets, but you definitely need to you have precautions. If you're planning to retire in the next 10 years, now is the time you need to be making sure that you don't see what you have get beat up. But what I am saying is that it is a significant discussion that has to be had about diversification. Now, some people say it's diversification. And yes, we've talked about that. Diversification can actually minimize returns on the upside and not work on the downside. But what we're talking about is cyclical and secular diversification, of understanding what does better at different times. And right now, with a middle class that's struggling, right now with a dollar that is, as Kirk was saying, and we have charts on that's showing it's going into big cycles, and the dollar has very long cycles. We have charts around that, where we may be entering the start of a very long declining dollar cycle. That has nothing necessarily to do with our president, nothing to do with policy. It or maybe it has some influence, but these cycles they are long-term and take place. If we're going into those, we may find that you need to change the way you think about your investing. That throwing your money into passive investments, like just throw it in the S&P 500, which has been the great transcendent advice over the last 20 years, just throw it there, may not work. And what Kirk's talking about very much lines into that. And that there are people in this world, and many of them outside of the United States, that are sitting much, much better right now for where things are possibly turning in terms of what will have the value and what will sustain that value. Things like potentially commodities and gold, et cetera, that they have more of that we're not looking at because, again, you may be sitting too centralized in one asset. Like, and again, most money being in the 401k, guess what you're mostly in? The S&P 500. If you're in a target date fund, guess what you're mostly holding? The S&P 500. Most models will have like 10% max in international. You are mostly, and if you're listening to this as an American, you're mostly all sitting in the same things. And as we've said before, the S&P 500, driven by momentum, is about 11 stocks that are driving most of that. I think the latest NVIDIA was 6% of that performance. So think about and really look. If you've got a decision you're making in a major use of your money in the next 5 to 10 years, and you're not doing something now to make sure that that's managed and that you're not changing the way you think about diversification, it's not that you might be at risk. The risks are already there. It's just you might be the one that gets affected by them.
So I want to touch back on a few things. There's a few charts here I wanted to share with everybody. So first one, I never see these, but if you're into diamonds, now might be a good time to go buy some. It's at a, I don't know, 25-year low for diamonds. I don't even look at these charts, but I just saw it and just chuckled. They're artificially high anyway because it's it's anyway. It's a managed market. It's a monopoly. Go ahead, Doug. You have one? You have a diamond?
I'm going to call a chart crime on this one, Kirk.
Okay.
And I'm going to tell you why it's a chart crime.
Tell me.
Because they're saying the ice is right, the timing, the mark. Here's the one variable that is now happening with diamonds. So if we go back, you started to touch on this, that diamonds have been manipulated forever. That actually we have more diamonds on this planet than we know what to do with. But De Beers, the ultimate cartel, we think Pablo Escobar was bad. He was bad. But De Beers had a much bigger cartel than the Medellin cartel ever had. And they hoarded those diamonds. They controlled them, and they controlled the release of them, artificial supply and demand. We have remember, we like to talk about this time is different, Kirk. What's different about diamonds now that has never been the case in history?
I don't know, Doug. You can tell me.
Artificial diamonds.
Oh, but we've had that for, actually, well, that's been around for a while, hasn't it?
They've been around for a while, but the price of creating them has plummeted. And I've actually talked to a lot of diamond dealers and individuals in the space. The number of diamonds that are selling now that are artificial, the quality that you can get in diamonds compared on these manufactured diamonds compared to the quality of natural diamonds, and the pricing is now you can get these artificial diamonds with better clarity, better quality, much, much cheaper. And De Beers, I wish I had this based on this chart because I didn't see this chart coming up today. The De Beers influence in that space has fallen to, I think they now where they had 90% of the market, they've got something less than 20% now. So it is a great time to go out and get diamonds. Investing in diamonds, I'd run the other way.
Yeah, I've never seen that as a good investment, but to each their own. Everyone's got their thing. All right, so I want to share this. I'm going to go back to gold for a second because there's some interesting charts I want to share. So one is this chart, which I find interesting. So foreign central banks hold more gold than treasuries right now. Now, if you look at this chart, it shows that treasuries were a long-time piece of foreign holdings, and they still are. It's actually at a higher point. The difference is they're no longer buying treasuries; they're buying gold. So you can see in the early aughts up to 2010, gold was kind of a low. It used to be high. It used to be in the 70s and 80s. It was like 75%, and then it started to plummet. Probably right around the time where we went off the gold standard. So people kind of called it a barbarous relic. Oh, we're not going to touch gold. But now central banks are coming back and saying, I see the light. I see what you're cooking here, and you guys are printed money, and we're not having any of it. So that's what happened in the 70s when effectively our dollar was pegged to gold, and then we just defaulted on it more or less. We said, yeah, we're not going to you're going to call us on our, because we were devaluing our dollar and it was pegged to gold, but I think it was the French that called us on it and said, yeah, we want the gold. And they're like, yeah, no, we're not doing that. So it was basically a default. People didn't call it that, but that's basically what it was. And I think what we're doing now is in the same vein. So I want to take you down this path. So I want you to just note this. It shows central banks have been buying. The Russian central banks have been buying since I think the tens, I believe it was. And the Chinese have as well. I think they have been for a while. But those two countries, they consistently buy, like always buying. So it's not like they're just rushing up to the table and saying, we got to buy everything. They got their own mines. They're taking their own stock. Like they're not moving markets, but they're definitely acquiring it. Now, if you look at, let's see the next one here. Gold. Now, this is a borderline chart crime. I'm going to say it in advance. Gold is favored as a safe haven over treasuries. This is since 2019. Chart crime, because they basically took a starting point and said, oh, look, everyone favors gold. Well, yeah, that also happens to be the time when gold started to take off. So it's a borderline chart crime, but I do want to point this out because there's a reason. I mean, forget gold. Gold could have gone sideways. The rest not taken off. It still would have been important because treasuries have become lackluster. Effectively, here's what's happening. For those of you who have not watched bond markets, for more or less my entire career, the Fed moves rates and the rest of the yield curve follows. So if the Fed says, hey, we're going to move the Fed's funds rate down 50 basis points, then the 2-year, the 5-year, the 10-year, the 20-year will kind of go down in lockstep. Not necessarily 50, but they'll move in lockstep. However, once we hit 2022, when everything went down, bonds went down, stocks went down, everything went down. Pretty much what's happened is people have realized, because take a step back here and say the bond investors are the smartest people in the room. People watch the bond investors because what they're doing matters. Stock investors, they don't really know what they're doing. But bond investors have to, because effectively you're loaning money at 5%. You want to make sure you're getting your $100 back, right? You're loaning 100, you're getting back 105. You want to make sure you get your 100. Equity investors are just riding the wave, but bond investors, it's all about the coupons, it's all about your principal. So it matters to them. And so when you start to see what started to happen is the rates have changed. So Powell lowered interest rates, like I said, right before the election, which was, not enough people called them out on that. I think that's a BS political move. The Fed has always tried to be apolitical. So people will say Trump's going to is going to make it more political. This is nothing new. Janet Yellen was a Democrat. Powell made that move before the election. Those are things in the past. Now, forget those moves, but in the past, like a few decades, they never would have done something like that, ever. They always stayed apolitical. They never would have done something before an election. They did it before Bush won, Bush Sr., and I believe he was not happy about that. So they try to stay out of that political game, even accidentally. But they dropped it right before the election, which I thought was BS. I didn't think they needed to drop it at all. And now Trump is chin-wagging, and he's browbeating Powell into dropping him again. There's a 96% chance they're going to drop rates on the 17th, just because Trump won't shut up. I don't think it's the right move. I think they should be higher. I think they should be in the 5% range. I don't think they should drop it at all, but they keep doing it. Why? Well, because they don't want a recession. So what's starting to happen, this is the point, is that if the Fed lowers rates, that the 5, the 10, the 20-year should drop in comparison, but that's not what's happening. So the Fed dropping rates, interest rates in the long end are going up. They're the correct ones because that's the market. The Fed is a monopoly trying to basically do whatever they're trying to do. The market dictates what's right and wrong. And the market is all the smart investors with all their money putting it up on the table are saying, F you, Powell, I don't believe you. We think rates are going higher. And so they're selling bonds, causing rates to go up. The Fed does not control the long end of the curve. Now, they can, sort of, but not really. If the bond market says, screw you, Powell, we're going home, not much Powell can do. And so you need to keep this in mind, that people are getting away from treasuries. Now, we've talked about in the show, we like short-term treasuries like 3 month, maybe 6 month, maybe up to a year. I would not buy 20-year treasuries. I think that you're just looking for trouble. But people do it. People buy the 10-year. It's right around 5. It's a little less than 5% now, I think. It's not a bad rate. But what the bond market is saying is, we think inflation is going higher. We think that bonds are worth less than you're saying, Powell. So the point being is, people are buying gold, they're not buying treasuries. And I point this out because historically, treasuries have been a safe haven. Now, they're no longer the safe haven they used to be. Now, gold is being considered a safe haven. Another reason why gold should continue to take off. I want to point this one thing out, and I'll hand it back to Doug. He can take us home. But this is the stuff, the kind of stuff that's going around this month. I've been hearing about it for the last 4 weeks. I heard about it in August. Oh, September is going to be a bad month. It's going to be bad. It's good this year. September is when it's going to happen. Let's get out of the market. Well, if you look at the data, that's true. If you look at historical data, the market should be negative. Not by a lot. We're not talking about a 20% sell-off. We might be down 1 or 2%. And right now, I think it's probably around there. So, that's okay. It's not a crash. It's just down a little bit. Now, I have a few clients who text me like, what's going on? The market's down. I'm like, the market's down like 0.5%. What are you talking about? Like, I know it hasn't done that in 6 months, but it does happen. So here's the lower charts one I wanted to share, which is the cumulative return by trading day in September, looking back 35 years. Okay. Basically what it says is right around mid-month is when the market starts to decline. And they decline, and then October can be a bad month depending on what's going on. November somewhat, but September's kind of when it starts. So it's sell in May and go away. I forget it's something until October. I forget the first part. It's like get sober in October or something like that. But it's not that. But there's some phrase in Wall Street that's hung around for a long time. Basically, May to October, you stay out, and then you get back in October. I don't know if I buy that. November is my thing. November is great. September is a bad month. So I just wanted to share this. This is a lot of cumulative data. It doesn't mean this is what's going to happen. It just means in the past, this is what's happened. And a lot of people are looking at this saying, oh my God, September's going to be a crazy month. I don't think it'll be a crazy month. I think it'll be a lackluster month. I think it'll be probably flat, a little up, a little down. I don't think it's going to be crazy. I think the market needs to take a little breath. But here's what I do think. I think that this market is really interesting. If you look at 4-year cycles, the presidential cycle, right, which is, a very common one people look at. The first year of the presidential cycle is strong. Second year, typically weak. The second year is typically not a good year in the presidential cycle. It is frequently down in the second year. Obviously, many years that hasn't happened, but if you're going to look at a cycle, it's pretty consistent. Third year is good, and the fourth year is great. So first and fourth years are the best. Second year is not good. Third year's starting to take off. So we're coming into a second year. Now, normally, in any other politician, I'd say, all right, maybe it's time to take a break in the second year. But we got Trump. So I don't know what's going to happen. I don't think anybody does. And you can't handicap Trump. If we could, we would have predicted he would have beat Hillary. We would have predicted he would have beat, Biden both times. But nobody predicted that. And so we're not good at predicting Trump. Let's just say that, right? You look at the tariffs, people still can't make heads or tails. They think it's bad, but yet the economy is still fine. I'm not saying it is, because things like tariffs don't happen right away. It takes 6 to 12 months before you start to see the impacts economically. So even though tariffs have not been a bad thing so far, it doesn't mean they won't be. I would say right around October until next April, if we start to see signs, I'll say, okay. If we make it past next April, I'd say, okay, maybe it's good. But that's just me. I'm just trying to be totally unbiased as much as I can about the whole thing, because I really don't know. I buy into the logic of what people say, but Trump doesn't operate by logic. And frankly, he's frequently right, whether you agree with that or not. He's frequently right about things. He doesn't get the credit for it. And sometimes he does it very poorly, let's be honest. But he in certain directions. Directionally, he tends to be correct. How he does it is usually obnoxious to people, but the direction tends to be accurate. So if this is the direction, that's why I'm giving him pause. I'm saying, okay, let's see what happens. I don't see how it's going to benefit, but I'll take a pause and say, okay, show me. I said this when he was on Joe Rogan's show. I don't buy it. I don't agree, but I'm open to listening. So we'll see what happens. And Scott Bessent, by the way, brilliant guy. Trump's not making these decisions necessarily. I mean, Bessent's a really smart guy. So I like his ideas. I don't know if they'll all pass. I don't know if they'll all work, but I like Bessent's ideas. I think he's in the right direction. A lot of the stuff he's doing, I think, is very good. So, we'll wait and see. The proof's in the pudding, as they say. You could have good intentions, but the road to hell is paved with those. So it's not about good intentions. What's the result? So, all right. So, Doug, why don't you? Oh, I wasn't even sharing this. Okay, did I share this, Doug? Do you remember? Did I share this at all? Okay. Well, anyway, go ahead. You're muted.
You were sharing that. Sorry.
Okay.
Yeah.
All right, perfect.
I'm having mute button issues today.
No
talking to myself, going back full circle.
Here's the other chart just while Doug's talking. Go ahead.
Yeah, no worries. So I want to touch on that because the saying you were talking about, and this may not be the one you're thinking of, but it was called "Sell in May and go away, come back on St. Leger's Day." Which,
that's what it was.
Yep, which refers to the St. Leger Stakes, which was a major horse race in England held in late September. And the saying suggests investors return to the market around this time, which is roughly equivalent to returning in late October or November. However, interesting because since it occurred in September, that's where the comeback in October idea came from. But you alluded to something that's probably a better indicator if we're going to be following this at all. We're not saying you should, but it's the Halloween indicator. A more recent term of the strategy suggests that investors might be rewarded better by returning to the market on around Halloween at the end of October. Interesting, so what there's some research out there that kind of shows that, and this was from Forbes, between looking at, I clipped it too early, but between, let's see, what are the years on this? Oh, index averages from 1970 to 2023. Between May and October, the S&P 500 average return was 1.6, whereas the November to April return was 6.5%. So clearly a big difference over the long run of about 5% average. The Dow 0.7 versus 7.6, so about a 7% difference. And then the NASDAQ 2.9 versus 8.8, so almost a 6% difference. So again, historically, but is that going to happen every year? The answer is of course not. And that's what makes it very, very difficult to use that as a going metric. LPL Financial put out some research that showed that, again, May to October trends do tend to be underwhelming. That if you look at the returns that have occurred, some of the best returns that they modeled was about a 6.6% average return between October to March, 7% between November to April. So coming back in November, as you said, Kirk, does seem to make sense there. December to May, 5.6%. And then the only other one that was above 5 is July to December. The worst months, April to September and May to October, which averaged about 2.7 and 1.8% respectively. So, again, there is some historical context, and the VIX seems to reflect that too. The VIX average percentage change is typically July, August, September, and October are the months in which it averages over 4.4% change from 1990 year to date on the VIX. So a lot more volatile. There's a number of reasons for that. And again, even October. November is the best month on the VIX with a negative 5.6% change. So VIX going down, meaning less volatility. Interesting enough, there is one month in there that is extremely volatile that is in that comeback in November. February, the VIX generally up about 6%, whereas it was negative in March, April, May, and June as well, and only up 2% and 1% in January, December. So again, those middle months, if you were to sell in May and go away, interesting enough, the VIX was actually down for the beginning part of that. It's really the latter part of the summer that it seems to have a lot of that potential volatility. So a couple notes that I wanted to see, I was going to kind of a touch base on, as we know, the college planning side of things. Things are getting tougher for people. College enrollment, they're projecting to go off of a cliff. Again, these are projections, so I do look at these as a little bit of a chart crime when you start getting beyond 2025. But the number of 18-year-olds in the United States has been, from about 2012, was kind of bouncing between 8.5 to 9 million. It did spike up to about 9.5 million 18-year-olds in 2025. So we've hit a peak, but now they're starting to project a massive decline of forecasted 18-year-olds in the United States, which could be a looming crisis for colleges. Not only are we're kind of getting a double whammy for colleges. This could be in your good favor. It could also be a crisis because we could see a number of colleges end up going out of business because of this, whether you agree with that or not. The kind of consolidation of more schools, less schools and more kids, that these kids are going to clamor to. But as we look at that situation, we are seeing that not only are we going to see a stressor from the new One Big Beautiful Bill and the changes that have gone there and what's going to be available in terms of financing for college, but obviously then a drop off of not only the number of kids that want to go to college or traditional versus trade schools, but just the number of kids in general. Simultaneously with that, we are starting to see more pressure on families. More than 20% of mortgages now cost homeowners at least 6%. That's the most in over a decade. So what does this mean? What are some takeaways that can come from this? Well, ultimately, the reality. We talked about the rising of gold and commodities. The world has shifted. Treasuries are buying gold. As I said, the foreign middle class, they've been stockpiling metals. The dollar has lost nearly half of its value against gold in just 5 years. Platinum, silver, miners could be breaking out while the dollar stumbles. And at the same time, U.S. colleges and families face a demographic cliff. Fewer students means higher tuition pressure. There's less forgiveness. They actually talked about loan forgiveness, and now they're going to start implementing a tax that they had really been suppressing, that you could be taxed by any loans that were forgiven. They had suppressed that. They weren't forcing people to pay that tax. They're now saying that they're going to start taxing these families who are getting this loan forgiveness. So that surprise hit. Who thought loan relief would bail them out now could create a cost for years. That's, by the way, not a middle class problem. That's hitting high earners too, often at the worst possible moment. So what is the real danger? It's not whether or not you've built a pile of money. It's whether you can turn that pile into reliable income that lasts. Retiring, as I said, into a downturn, generally worse than retiring in a boom. It's not a question or if the risk hits, but when. And the same is going to be true for college. The tuition is going to drain today what can quietly rob your future income tomorrow. Most people stick with the same old advice, just 529 or cookie cutter debt strategies or half-truth sound bites that feel comforting but cost families millions. Or they just wait on hope and think they're going to get a bunch of scholarships. And the reality is times have changed. Doing the same old thing doesn't work anymore. So I'm going to give you a gut check. If you've had any doubts about whether you're getting the right advice on college, on retirement income, on protecting your wealth, listen to that voice. More stories are coming out about millionaires with $3 million plus still worrying about running out of money, not because they don't have enough, because they don't know. They don't have a plan. So do it differently. Take control before the system puts you in a hold. Visit mergentadvisors.net. That's MERGENT, mergentadvisors.net, or mergentcollegeadvisors.com. Let's make sure you're building income. Let's make sure that your future won't be compromised by the decisions you make today for college. Don't just build a pile, protect your future instead of draining it.
Great. Well, thanks for coming on, Doug. Just actually, I wanted to share this one more chart I forgot to. It's basically stock market sentiment. A lot of people are bearish. And this is I couldn't find this before, but more people are either bearish or they're cautious. 33, 32%. Very few people are bullish. That, oddly enough, is bullish. So this is where I mean before when I said, everyone's ready to sell. What's the least likely thing to happen? It just keeps going higher. So I only point that out not because I think it's going to go up or down. I really don't have a dog in the fight. I think it's overvalued. But I did want to point it out because what you see is these are the different sentiments at different times, different weeks. A lot more people are bearish at all-time highs. So just something to keep in mind. Don't pay attention to other people unless you're doing it for maybe if you want to be a contrarian investor, but try to ignore the crowd because the crowd is frequently wrong, but never in doubt. So that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send an email and express your feelings. If you're looking for financial advice, talk to an oracle, or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest